Hi everyone, it's Grace. Welcome back to my channel. There's a lot of things going on in the past few weeks, and it already feels like we're going through a century of events. In today's video, I want to focus on how inflation affects us in the economy in the context of many political and economic events that are happening right now. So let's get started. Before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. The primary reason why I spend so much time observing and analyzing the behavior of the Fed is because it holds a lot of power to determine economic development and market outcome. The second reason is that, like in China, in the US, the economy is also kidnapped by the real estate sector. I use the word kidnapped because real property is interwoven with a lot of other asset types and is the last fortress for asset investment and household and business development. It all comes down to tangible and intangible asset, and tangible asset is still the most resilient asset types of all when faced with market volatility. I know some of you are waiting for the housing market crash to purchase a property, but remember that timing is important. But also remember that a lot of pension funds and social security funds are invested in the initial capital investment of real estate. People with pensions, regardless of how old they are, depend on the growth of property values and continuous rental income for their existing or future retirement. Imagine if the Fed increased the Fed funds rate by 50, 75, or 100 basis points immediately, the stock market and real estate market will collapse simultaneously, and the equity values that you've built since before the pandemic will be gone. I think China is a perfect counterexample of what happened to the economy when the entire real estate sector collapsed, and what abrupt policy did to the economy. The Chinese government and the central bank keep going back and forth, which creates a lot of economic and financial instability because once an economic policy is executed, it cannot be reversed. Now, almost no one buys properties in China. The abrupt policy pops the asset value among all asset types without any warning or reaction time to the market. So you can't really be that surprised if the economy in China is on the edge right now. And imagine all the other sectors and parties that depend on the appreciating value of properties for business, like banks, local governments, construction companies, contractors, subcontractors of all kinds of services. And it has a chain reaction to the rest of the supply chain that's based on property value. So that's exactly what I mean when I say kidnapped. So now let's take a look at what has happened in the market so far and how they affect the inflation and the Fed's decision. I'm very surprised and shocked that Russia invaded Ukraine. I'm like, this is the 21st century, right? The consequence of the invasion is that a lot of countries are imposing economic and financial sanctions on Russia, including stopping some Russian banks from the SWIFT messaging system, freezing foreign assets that Russia holds overseas, banning of airspace, and limiting technological access and energy trade. What I fear the most is that this kind of unprecedented economic sanction is going to be permanent given how bad the war is, and Putin's decision to invade Ukraine is basically an economic suicide. In this sense, I think that the sanctions have a greater impact on Russia than on the US. This is also reflected in a comeback of S&P 500, Dow Jones, and Nasdaq. I think that this is because Russia's economic connections with the US are not exclusive, and the US market has a strong diversity. It's times like this that you realize just how important diversity is, and I'm glad to see that the US market is very resilient to global market volatility. And then let's talk about the energy price and how that affects inflation. The US has not imposed the sanction of crude oil from Russia just yet, and there has been some talk that Russia may impose a counter-sanction of oil export to the US and the rest of the world. I don't think the impact is going to be super big if it ever happens. Let's take a look at the worldwide oil reserve and production. As for oil reserve, Russia's reserve is more than the US, but less than Canada. As for production, the oil production in the US takes up 20% of the world's total production, followed by Saudi Arabia at 12%, and Russia at 11%, and Canada at 6%. So Russia certainly has a substantial portion of the crude oil production in the world, but not significant enough to change the entire oil supply. In the short run, Crude oil is still the main energy source for industrial production, and a war will certainly have some impact on inflation. But this is also an opportunity for new energy to develop. If Russia decides to sanction its oil export to the US and the rest of the world, it will give the right push for companies to develop new and alternative energy sources to support industrial production and economic growth. I think this might be a very good opportunity for the US economy to reduce its reliance on oil, and it will also be very helpful to tame inflation. If in the future, crude oil is not the main energy source, inflation will be much easier to reduce, and we may open a new economic era. So that's pretty much what I think how the war impacts inflation. And the second event is the relief of the mask mandate for business. The removal of mask mandate is good news to remove the tension on inflation. I know that most states already lifted the mandate in the later half of 2020, but because COVID cases were still serious until up to this point, companies were still mixed in the actual practice of the mandate. Most companies still carried out the mandate among employees because it effectively prevents sickness. But now, as COVID becomes more and more like the regular flu, removing the mandate seems more reasonable than back in 2020. I think this is a good start to gradually relieve supply chain shortage and rebalance supply and demand. So now, let's take a look at how inflation affects us as we take different roles in the economy. Inflation will directly affect business. I think that CPI is a more popular inflation indicator. People talk about it all the time when referring to inflation, but it's also weighed heavily by the oil price. So it's not really direct in the sense that consumers will feel like a huge impact of a price growth. So that's why I think inflation has a direct impact on business, which has to buy materials and hire human resources at the cost of the market value. Anything paid below market value will probably suffer in quality. So business is the first to feel the impact of inflation. I remember seeing a news about an alleged homeless guy stealing like 10 packs of steak from Trader Joe's in New York. The staff tried to stop him, but did so only to retrieve the basket, and he still ran away with the steak. One of the staff said that if they did anything otherwise to the guy who claimed to be homeless and hungry, they will get into trouble. For whatever reason that Trader Joe's decided not to intervene, the actual result is that the increasing cost of the steak became the cost of Trader Joe's instead of the homeless guy, who could have been a regular consumer if the price of the steak stayed the same as before food became more expensive. There was another interesting piece of information related to the news that some retail stores that sell steak and fish had shoplifters who deliberately stole expensive items from them to resell at illegal venues. Imagine a chain store like Trader Joe's could probably suck in these costs from shoplifters. Either they're really hungry or just plain fraudulent. But what about these small store owners? How can they continue doing business while suffering from these costs? So this is why I think inflation has a direct impact on business, especially small business who are more financially vulnerable to inflation. And this is precisely why I think the impact of inflation on consumers is indirect. Producers buy materials with higher price that reflect on the market value because they have no other choice. But consumers can choose where they buy. If the food price of a restaurant increases by 50%, which is a very steep price increase, and it's actually happening more often than you think, the consumer can choose to eat somewhere else or just order a smaller amount. Because as a consumer, if a product doesn't fit your family budget, it just doesn't fit. And you may switch to a different product until it fits your family budget again. So inflation has more impact on producers than consumers, and it puts businesses, especially small ones, on a very tough spot. And the last thing I want to talk about is how inflation affects people with low income. Inflation will most likely not be curbed this year. It's a gradual process. People with low income are going to be worse off if there's an immediate recession where more businesses are closed or go bankrupt, stock market crash, property values drop, and all the efforts built since before the pandemic will be completely wiped out. I think one possibility is that the government will be focusing more on solving the supply chain problem while planning and executing the rate hikes more cautiously. In the sense that the peak point and the bottom point of the stock market and the real estate market are jagged instead of synchronized. So this is today's video about how inflation affects us, and I hope you find it useful. Let me know in the comment section down below what you think. As always, thank you very much for watching, and I'll see you on the next one.